Hello and welcome. Equity Linked Savings Scheme, ELSS in short, is a tax saving mutual fund. Now, what's a mutual fund? Mutual fund is a trust which collects money from a number of investors. The money so collected would be invested in various instruments like equity shares, bonds, etc. to earn returns. These mutual funds are managed by professional fund managers. ELSS is a tax-saving mutual fund because it offers you income tax deduction benefit up to 1.5 lakh per annum under Section 80C, thus effectively letting you save tax up to a maximum of about 47k if you are in 30% tax bracket. These ELSS funds have to make a minimum of 65% of investment in the stock market. And these investments are spread across various sectors like financial services, information technology, energy, healthcare, and so on. This can also depend upon the market capitalization, that is large, mid, or small caps. Basically, this would depend upon the investment objective of the fund. As these assets are invested in the stock market, ELSS is considered as a high risk investment option. At the same time, it offers you higher return, say a minimum of 10 to 12% per annum. If the market is performing good, then return can be even higher, say 20 to 25%. On the other hand, if the market crashes, then you might as well end up making losses. This ELSS investment, either you can go for a lump sum payment, that is a one-time payment, or you can opt for SIP, that is systematic investment plan, where you pay a fixed sum of money at a predetermined time period, say monthly, quarterly, even weekly, fortnightly options are available. Say for example 1000 rupees per month. In comparison to other ATC investment options, ELSS offers you the shortest lock-in period, which is 3 years. Now that we have got the basics covered, let's understand a bit more about tax deduction. For this, let's consider a simple example. Let's say your gross salary is 1 lakh per month. So for the year, it will be 12 lakh. Let's assume your PF contribution, that is employee contribution, would be 5,000 per month. So for the year, it is 60k. You have no other investments. So total ATC deduction for the year would be 60k. And hence taxable income would be 11.4 lakh, on which you would be required to pay an income tax of about 1.61 lakh. Let's consider another scenario. Your gross salary and PF would remain the same, plus you have an ELSS investment of 1 lakh. So your total investments for the year is 1.6 lakh, and your ATC deduction would be limited to 1.5 lakh because that's the maximum limit, and your taxable income would be 10.5 lakh. So income tax that would be payable is about 1.33 lakh. So effectively this has led to a tax saving of about 28k because of this additional investment in ELSS. Wait a minute, why only ELSS? Because ATC offers you various investment options. So if you choose any of those options, you would still be able to save taxes to the same extent. But ELSS is preferred over other investment options. Before we understand how, we need to learn a bit more about ELSS, starting with the investment options. You have 3 investment options. First one is growth, then dividend payout, third would be dividend reinvestment. If you opt for growth fund, then your income would be the gains that you make on the capital appreciation at the time of redemption. That is after you complete the lock-in period of 3 years. Capital appreciation is the difference between the sell value and the buy value. If the sell value is more than the buy value, then you would end up making gains, and that would be your income. To put it differently, if you opt for growth fund, then you would not be receiving any dividends. Next, dividend payout. Here you would be getting periodic dividends, that is as and when the corporates declare dividend, you would be getting dividends, that would be your income, plus gains on capital appreciation. But the capital appreciation would be reduced to the extent of the dividend that has already been declared by these corporates. Third option would be dividend reinvestment. As the name suggests, dividend declared by corporates are reinvested. So your income would be the gains on capital appreciation, and this capital appreciation would include even the reinvested dividends. But if there is no capital appreciation or if no dividends are declared, then you will end up making losses if you invest in ELSS. Next topic would be tax treatment on redemption. That is, after you complete the lock-in period of 3 years, you will be able to get your money back. So how is this money that you get back would be treated as per the Income Tax Act? Let's understand. Let's say you have invested in a growth or dividend reinvestment fund. So whatever gain that you make on capital appreciation would be a long-term capital gain for you. This is because you have to hold the asset for a minimum period of 3 years. So if you have to have short-term capital gain, then it is possible when you sell the asset within 12 months. So in respect of ELSS, you can never have short-term capital gain, and these long-term capital gains are exempt up to 1 lakh per annum, and LTCG over 1 lakh would be taxable at a flat rate of 10%. On the other hand, if you opt for the dividend payout fund, then whatever gain you have on the capital appreciation would be your long-term capital gain, and tax treatment would be same as that for growth or dividend reinvestment fund. Plus, whatever dividends that you receive would be taxable at slab rate. That is, if you are in 20% tax bracket, then 20% would be applicable on dividend that you receive. If you are in 30%, then pay tax at 30%, and so on. To understand this better, let's consider a simple example. Let's say you have an investment in the SBI Long-Term Equity Fund. It's an ELSS growth fund. Let's assume your initial investment was 1.5 lakh and this was made on 1st September 2019. So 3-year lock-in period would be over by 31st August 2022, and let's assume its current value to be 2.6 lakh. Let's first compute long-term capital gain on this transaction. Redeemed value would be 2.6 lakh and purchase price is 1.5 lakh. So the difference between the two would be your long-term capital gain, which is 1.1 lakh here. Let's compute income tax on this transaction. LTCG is exempt up to 1 lakh, so no tax on it, and over 1 lakh, that is 10,000, tax that would be applicable is 10%. So income tax applicable here is 1,000. What if you have opted for SIP instead of lump sum investment? In that situation, how is LTCG computed for SIP? Let's understand. Let's consider the same example, SBI Long-Term Equity Fund. But instead of lump sum payment, let's say you have opted for SIP, that is 5,000 per month, and this started on 1st September 2019. First, let's compute the lock-in period. For the first payment, which is made on 1st September 2019, 3 years would be completed by 31st August 2022. For the second payment on 1st October 2019, the lock-in period would be over by 30th September 2022. For the third payment, which is made on 1st November 2019, 3 years would be complete by 31st October 2022, and so on. You got the point. Now let's compute long-term capital gain on the first payment, which is due. So the lock-in period is over on 31st August 2022. Let's assume its current market value to be 10,000. So redeemed value would be 10,000, purchase price is 5,000. So the difference would be your long-term capital gain, that is 5,000 here. The same method would be followed to compute long-term capital gain for each of the SIP payments, and the total for the year would be your long-term capital gain. But what if you want to continue this investment even after the minimum lock-in period of 3 years? Is it possible to continue? Whether you opt for lump sum or SIP, it is possible for you to continue even after 3 years. This would depend upon the scheme. So you can check the scheme information document to know more about it. When you consider investing in ELSS, you have two options to make payment. One is lump sum, the second one is SIP. Now, which one to choose? Lump sum means one-time investment. So if you are not having regular income, say you are self-employed, then the better choice for you would be to opt for lump sum payment. On the other hand, SIP is for those who get regular income. Say you get salary, then the best option for you is to opt for SIP. Also, this SIPs would help you have your investments for the purpose of tax deduction under section 80C for every year. But lock-in period would vary if you opt for SIP. Now that you have understood about ELSS, if you would like to invest in ELSS, then how can you do that? It is very simple. You can do it online. You have two options. First, if you have Demat account, say with Zerodha, Upstocks and so on, you can open this investment from the portal of these brokers, or you can even use their apps to have your ELSS investment started. If you do not have Demat account, then you can also directly buy this. For example, if you want to buy SBI ELSS, then you can go to SBI Mutual Fund portal, click on Investment Solutions and select ELSS Tax Saving Funds. Click on Invest Now and you would be able to open this ELSS investment by following the instructions on the screen. Now let us see what are the things to consider before you invest in ELSS. First, from the viewpoint of investment options, growth or dividend reinvestment fund would be a better choice than dividend payout fund. This is because the dividends that you get when you invest in dividend payout fund would be taxed at slab rate. If you are in 20% tax bracket, then you have to pay 20% tax on dividends. If you are in 30% tax bracket, you pay 30% tax on dividends and so on. But if you opt for growth or dividend reinvestment fund, then long-term capital gain would be exempt up to 1 lakh and anything over 1 lakh is taxable at a flat rate of 10%. So even if you are in 20 or 30% tax bracket, you will end up paying tax at 10%, which is beneficial to you. But if you are in a tax bracket less than 10%, then dividend payout fund would be a better choice for you because you would be paying lower taxes. But tax treatment for long-term capital gain would be same. Next question would be choosing the fund. That is, which fund to choose to invest. You may consider certain parameters before you decide on the fund. First would be past performance of the fund as well as the fund manager. So how do you check the past performance? It is good to look for CAGR, that is compounded annual growth rate. CAGR in simple words is the average annual growth over a period. Let's say a fund has a return of 10% CAGR for the period of 3 years. This means the fund is offering you on an average 10% return every year for the period of 3 years. 1 year it could be 8%, the other year it could be 12%, but when you average it out for 3 years, the return would be 10% per annum. So look for CAGR. Next, profile of the fund manager. Look for the experience, qualification of the fund manager because the fund manager is the one who is going to manage your investments. Next parameter to consider is expense ratio. That is the fee that you pay to these asset management companies to manage your investments. It is better to choose the fund which offers you a lower expense ratio. But there are certain exceptions, like some funds may give you high returns by charging higher expense ratio. Then third parameter to consider is to read thoroughly the scheme information document because this document would contain investment objective of the fund, sectorial investments, that is in which sector the fund has planned to make investments, and also what is the proportion of investment in different companies and so on. I know scheme information document is bit lengthy, but if the value of the investment is significant, then it is always recommended that you go through this document before you decide on the fund. Now that you have decided the investment option and also zeroed on the fund, then the next question would be how much to invest. This would depend upon the objective of your investment. If the purpose of your investment is tax saving, then check your ATC limit before you invest in ELSS. Because if you have already exhausted your ATC limit, then ELSS is not a better choice for you. On the other hand, if you have not exhausted the limit, then opting for SIP over lump sum payment would be a better option, because payments are spread over years. So this would help you take care of investments for the purpose of tax deduction under section 80C for every year. But this limit of 1.5 lakh is only for the purpose of tax deduction. In other words, this is not the limit for the investment. That is, you can invest even more than 1.5 lakh, say 2 lakh or 3 lakh, but the tax deduction benefit would be limited to 1.5 lakh. So if your purpose of investment is not just to save your tax but to earn higher returns, then you may consider investing in ELSS even though you have exhausted your ATC tax deduction limit. Next important point to consider is this ELSS, it is not for those who are risk averse. That is, those who do not want to take risks or those who can invest only in low risk investment instruments. Then if you are risk averse, then ELSS is not a better choice for you. In this case, you may consider other ATC investment options like PPF, tax saving FD and so on. But if you are not risk averse, that is, you are ready to take moderate to high risks, then ELSS is a preferred choice over other ATC investment options. Let's understand why. First reason would be ELSS has the shortest lock-in period. If you invest in PPF, you have to wait for 15 years, NPS till you are of the age 60, tax saving FD you have to wait for 5 years, but ELSS offers you the shortest lock-in period, that is 3 years. Next reason is higher returns. If you invest in PPF or tax saving FD, then you may expect a return of about 6 to 8% per annum, but ELSS offers you a minimum of 10 to 12% per annum, and if the market performance is good, it can be even higher. But at the same time, it is considered as a high risk investment option. Next reason is better post-tax returns. If you invest in ELSS, then long-term capital gain up to 1 lakh is exempt from tax. So you don't pay any tax up to 1 lakh. And after that you pay tax at a flat rate of 10%. So even though you are in tax bracket of 20 or 30%, you would still be paying 10% tax. Apart from all these benefits, ELSS also offers you tax deduction benefits up to 1.5 lakh per annum. So effectively letting you save tax up to a maximum of 47,000 if you are in 30% tax bracket. That's all I have for you today. Thank you for watching.